Last week, we discussed 30-year rate cycles and how stocks and rates can rise together over the long term. We also discussed potential downside in the short term. As we remind viewers in all of these videos, much of the material presented is observations of the long-term trends. Building on Churchill's quote, we look back at long periods of history to determine future probabilities. There's a saying that the market takes the stairs up and the elevator down. Last year felt like an escalator up, and this year we've taken the elevator down twice. Drops of 5% or more occur on average 3 times a year. The question is always whether this is the start of a larger downward move or if this is a return to normal volatility. This week we'll look at the mechanics of downside momentum, the health of the long-term trend, the bounce, and where we might go from here. First, we'll look at a summary of this week's economic data and interpretation. Despite the market's performance, this was another week of record-breaking economic data. We had the third highest reading of business confidence in 35 years, the lowest 4-week average of initial claims since 1973, and CPI, a measure of inflation, came in a little soft. The market was clearly not being driven by the economic data this week. Now we'll look at our week in review, where we take a look at the headlines and how they move the market. On Monday, tech sold off in the face of rate pressure and dragged the market down with it for a relatively weak close. On Tuesday, the S&P continued to slide as rates hit a multi-year high. On Wednesday, the Dow dropped 832 points as fear gripped the market. On Thursday, a failed morning rally was reversed by a sell program with strong momentum to the downside. On Friday, the market staged a relief rally and ran into overhead resistance. The market closed down 4.1% for the week, and the month and year-to-date statistics are provided at lower right. This slide is from last week's video and shows that over the long term, stocks and rates can rise together, but neither rates nor stocks will rise in a straight line. While this week's headlines were dominated by rate fears, the markets and rates have risen together prior to this week's decline. When rates declined this week, the markets continued to decline. This shows that whatever the reason for the sell-off, momentum is the driving force behind trends up or down. You can see on the chart that rates are going up and we've entered an inflationary cycle. This signals a change in the relationship between stocks and bonds. We think of bonds as helping our portfolios when the stock market declines. As we change to an inflationary environment, has that been the case? This is a chart of the 10-year note. The red and black line is the price of the 10-year, and the S&P is the green line. When the S&P declined early this year, bond prices didn't rise, they fell along with the market. Bond prices continued falling as the market recovered. How did they do in this sell-off? Bond prices again fell as the market declined. Bond prices have fallen steadily throughout the year as rates continued to rise. Whenever you get a period of volatility in a rising bullish trend, it's helpful to look at a long-term chart. So we'll start with a weekly chart of the S&P. Last week, we mentioned that it would not be uncommon to test the January high, just as we saw after the 2015-2016 correction, where we broke out to the upside of the consolidation, came back, and retested it. We rose in a rising channel to the January high, and then we corrected again. We found support at the 200-day moving average and the bottom of this rising channel. We broke above this consolidation, and this week we did break through the January high, and it now becomes resistance. The next level of support was the March to mid-June highs, and we broke through this level as well. The bottom of this rising channel is serving as support for now, as is a line of support from the January high to the peak in mid-June. Now let's zoom in and look at the mechanics behind short-term momentum to the downside. We cleared the January high and resistance becomes support. We get a rising window which refers to this gap here, which also becomes support. Then, as we noted, we get this engulfing candle which tests support and holds, but portends potential to the downside. Now below these support levels are millions and millions of stop loss or market sell orders placed to protect profits for all kinds of reasons that you see displayed in this word cloud. This represents a huge amount of supply if support is breached. We broke through the January high, and these support levels became resistance. We break through with momentum to the downside as all of these market sell orders are triggered. The algorithms accelerate the sell-off and run stop orders. You can actually buy data on where the stops are. Once we run out of stops or supply, the algos buy. You're out of your shares at a loss, and then price goes back up. Now let's look at supply and demand dynamics in the sell-off at the beginning of the year. We go into the January high, and the low of the previous candle or prior close can serve as support. We break through it, and support becomes resistance. Like we saw on the previous slide, we get a huge amount of supply from market sell orders. We get a very sharp momentum decline to the February low, which is a panic flush. Note the long lower wick of this candle. This is where the close is. This is where the low is. The price action here indicates strong buying up from this low. This is because we ran out of sell orders, and the algos kicked in and bought. We go back up to test resistance, and we fail. We go back down with a successful retest of the 200-day moving average a few weeks later. After the retest, demand rises steadily and drives the market higher until we break through the January high, at which point resistance becomes support. Now let's look at a daily chart for some landmarks and potential ways forward. This is a daily chart of the S&P with Fibonacci retracements drawn from the February low to the most recent high. Notice that the 38% retracement cuts right across the mid-June high and served as resistance today. Price recaptured the 200-day, and we have this long lower wick. Inside candles have an indecisive connotation, but the long lower wick also gives us a bullish indication. Price is likely to bounce around in this area bounded by the 200-day moving average and the 38.2% retracement until it breaks one side or the other. Given the long trend is up, probabilities favor an eventual break above the 38% fib, but most likely with some additional heartburn. If we fall decisively below the 200-day and below the low of this candle, the 61.8% retracement may serve as support, although we'll show an alternate view in the next slide. I've noticed that peaks, lows, outside bars, and gaps form borders of price discovery where price will often reverse or gap up above or below. I use these lines on my charts, but not in my model. Let's see what we can learn. The market fell to this line from the January high through the July gap and then reversed. Today's candle tested this line from the February low to the April 4th outside bar, as you can see here. There's an additional line of support that lines up with the 68% fib that can be drawn from the high of the January peak, which is also an outside bar, through the June gap and ends at 267.50. Just as there are support lines beneath, there are also overhead lines of resistance that can be drawn using this method. As we try to make a determination about whether this is a bounce or a bottom, sometimes it's helpful to look at a shorter-term time frame. A bounce does not mean the bottom is in. This chart shows the sell-off from January 26th to the bottom on February 9th. Here was the first bounce. You can see that this bounce was not the bottom, and that's why it's important when you are buying a bounce to make sure to use a tight stop and honor it. Here's the sell-off from October 3rd through October 12th, and here's the first bounce. Is it a bottom? There's no way to know until next week. Zooming out again, we'll compare and contrast to gauge the health of the long-term trend. Here are the moving averages for 2008 when the market rolled over. The trend for 2018 is a strong bullish trend, in spite of the correction early in the year. This is not an opinion. You can see the evidence yourself. In our model, we measure over 400 data points on a daily basis. The evidence could change, but it hasn't yet. We used this opportunity to make small buys, with volatility likely to remain high and a question about whether this is a bounce or a bottom. We're using very tight risk management on these new positions. We measure the strength of the trend for core positions in terms of years, months, and weeks. You can't invest on this time horizon by jumping in and out of the market without evidence in your long-term model instructing you to do so. Next week, We'll continue to measure the market, invest according to our model, and be ready to change if and when the evidence changes. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.